Let's separate what's going on in the past month with what's going on the previous 5 months. So the past month, was that mostly deal speculation driving up the sector?
A little bit. We saw a little bit of short covering in this space as well. Really beaten down group over the past 6-12 months with the yield trade working against this group and the M&A speculation also coming off.
What is the growth like in this sector when it comes to sales? I thought there was little to no growth.
Yeah, I mean, we're basically seeing flattish growth across the space in general. There's some pockets of faster growing categories, some of the snacking categories, some of the perimeter, you're still seeing growth in the mid to high single digits, but by and large cap food, still about low single digits.
We just debated on Halftime Report about whether or not the yield curve is going to invert. There was a time when you looked at these companies and you said, if you're worried about a recession, this is the place to go. Does that still hold, or are the issues that they're facing with changing consumer tastes so bad that that's not the case anymore?
The changing taste is an issue, and it's really questioning the defensive properties of the group relative to history. But what we do think on a relative basis, you are seeing a little bit less exposure in terms of tariff risk and the vulnerability there. So that could work in this group's favor. And in terms of valuation, you're seeing discounts relative to the market versus 35% premiums 3 or 4 years ago. So valuations have really come in, a little bit less vulnerability on the trade front too.
What's gone wrong with some of those bigger companies, whether it's a Heinz or whether a Kraft Heinz or a Mondelez or any of these big companies? What have they missed? Campbell's.
We think a lot of it's been self-inflicted. You know, coming out of the credit crisis for the first 4 or 5 years, you were seeing just general consumer malaise. And to counter lack of top-line growth, you're seeing very aggressive cost cutting, advertising coming down 30%, R&D coming down 10-15%.
Well, that should be good, right?
It was, and you saw the margins respond in kind. But the problem is now you're getting out into the out years. The innovation pipelines are really just lacking really good differentiated products.
And the millennials aren't buying it.
To some extent, no, you're not. You're definitely seeing a lot more focus on snacks from millennials, more fresh food, more packaged fresh, more frozen. But we think the big issue there for large cap food is just getting differentiated ideas back into the pipeline. General Mills, great example, launched Oui yogurt last summer, over $100 million in first-year sales, really differentiated products. So it shows there's still a success there.
How long does it take going from thinking up the idea in the R&D pipeline and actually getting it onto the shelves? How long does that take? And what percentage of those products, actually, I think of it like TV shows. There's lots and lots of pilots. Rarely do they become hits.
Yeah, you're right. You would think at this point probably 2 to 3 years, and figure most food names, this is probably year 1. So we think you should start seeing better sales growth 2019, 2020. I think there's been a notion moving towards bigger bets and concentrating your innovation on smaller ideas and putting more resources behind them, which is one way of I think, getting at that core consumer once you figure out what you're really lacking.
Even if we see better growth next year, when I look at the forward PE on this group, it looks like, to me, on the ETF at least, it's about 17.5, and that's still premium, slight premium to the S&P 500's forward PE. So if you say the defensive characteristics are questionable at this point in terms of what they have, the demographics they're serving, why should there be any premium whatsoever? Why should this group be bid up from here at all?
It's a good question. I think if you break it down by subgroup, the food stocks themselves trade about 15 times 2019 numbers. HPC, the household products names, elevate the overall ratio. So, I mean, again, you were seeing 35% premiums versus the market. 2 to 4% GDP environment. We usually see this group at a 10% premium to the S&P, and now you're at a slight discount if you're one of the food stocks.
Who's your favorite? Food stocks, though, right? Yeah.
Who's your favorite?
Our favorite in the global space is Danone.
Danone.
The French yogurt company.
Yes.
Why?
We think it's the best portfolio, really in global food. You've got exposure to infant nutrition, the yogurt business, plant-based beverages through the White Wave acquisition last year. We think there's upside to both the revenue and margins going forward.
Have you thought about whether or not it's going to be acquired, whether or not this new French president might actually let it be bought at some point? Is that any part of your calculation or no?
No, this is straight organic. Straight organic growth.
Okay, so outright M&A would be a bonus then.
It would be, yes.
If it were to happen,
it would be, yes.
If it was allowed. All right.
Very interesting. Right. I want to ask you one thing. The thing I remember from your notes are PWAMs.
Yes.
What are they?
People who aren't millennials.
I love that.
We're big thinkers.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.